the Federal Reserve is about to undergo a massive shift. During his speech earlier this month, Jerome Powell signaled that they might have to end quantitative tightening. This is going to have big implications for crypto and the wider asset market. So in this video, we're going to go over what is the likelihood of the Fed ending quantitative tightening? When will they do it? And what does it mean for us as investors? If you're excited to learn more, like and subscribe down below, and let's hop in to today's video. Now, guys, I know this is an exciting topic for a lot of people. When the Fed talks about ending quantitative tightening, what a lot of people think of is it's time to turn on the money printers, pump my bags. While that may happen sometime in the future, I don't think that's going to happen right away. However, ending quantitative tightening is a very big deal. It's going to be a very good thing for risk assets in general. So what is Powell actually talking about? Because he signaled at his meeting a couple weeks ago what they're actually planning to do or what they're looking at. So let's have a look on the screen. We've got his quote here. That's where he talks about this. So the long-stated plan is to stop balance sheet runoff at a level consistent with ample reserves. We may approach that point sometime in the coming months. We're closely monitoring this. Signs have begun to emerge that liquidity conditions are gradually tightening, and you can read the rest if you want to pause it and read it. So basically what he's saying is that it's almost time to end QT. The balance sheet is getting low. So what is quantitative tightening? Why do they do it? What is it? Essentially, quantitative tightening is just the Fed reducing the size of their balance sheet. They do this through a number of mechanisms. Sometimes they can just outright sell bonds. They can shift some money into their Treasury General account. What they also do most frequently is they let bonds roll off the balance sheet, called balance sheet runoff. Really what this is when it's time for a bond to mature, they can choose to repurchase the bond or they can choose to not repurchase the bond. When they choose to not repurchase the bond, it rolls off the balance sheet. The liquidity disappears out of the financial system and the overall level of liquidity goes lower. The Fed balance sheet shrinks. Now, why do they do this? Why does the Fed enter quantitative tightening? Well, they do this to drain excess reserve from the system. When the Fed does quantitative easing, when they add massive amounts of bonds to their balance sheet, they essentially create a massive amount of liquidity and inflation in the financial system. They have to eventually bring this down to normalize the plumbing, and they also have to create room for the next time they might need stimulus. If the Fed kept their levels high, the next time that the system needed an injection of liquidity, they would already be at max. The balance sheet would already be too big to add more to, so they have to draw that down. It's almost like a reservoir system. You fill it up, you draw it down, you fill it up, and you draw it down. It's almost kind of why they call it the plumbing. It's a good analogy. And so in an earlier video, we covered what was actually behind the massive sell-off that we saw a couple weeks ago. This was due to a number of things, but primarily due to a fundamental lack of liquidity in the system. This sent a clear message to the Federal Reserve that it's time to think about ending their balance sheet runoff because the balance sheet's getting too low. Liquidity is becoming too scarce. I think that they'll have to end QT sooner than later. Some people think it'll be in 2026. Personally, I think it'll be in 2025 due to that sell-off and that liquidity tension that we saw earlier. And this is also what Danielle DiMartino thinks. She used to work at the Fed. She has some insights on this situation. Check out what she has to say.
Will the Fed be forced to pull the plug on quantitative tightening? It certainly looks like the system is running out of sufficient liquidity and that the Fed is going to be forced to pull over to the sidelines.
So the Fed is running out of liquidity and the system's running out of liquidity. This is no good. The system needs liquidity to function. So this is a chart from Mike Howell over at Cross Border Capital, and this demonstrates perfectly the need for liquidity in the system. This middle line is kind of the neutral point where there's a fine balance between debt and liquidity. When you have ample liquidity, when you have more liquidity than is needed to refinance debt, you get asset bubbles. You can see that down here. US housing bubble, Y2K bubble, everything bubble. When you have refinancing tensions, when there is not enough liquidity in the system relative to debt, you get economic crises. You get the Lehman crisis, you get the Y2K crisis, the Eurozone banking crisis. All of these different financial catastrophes occur because the system starts to get clogged up. And that's what we saw earlier last week. We saw the system start to get clogged up a little bit because there's not enough money in the system. This is because the Fed is drawing down their balance sheet. And you can see that dynamic widening here. The change in SOMA, that's the Fed's balance sheet, going down, change in federal debt going up. So we've got this massive jaw. Eventually, this is going to have to snap shut. But for right now, we can see that it's moving further and further away. And so why does this matter for us? So if we go over to TradingView, we can see there's a strong connection between the US central bank balance sheet and others. That's the total market cap minus the top 10, so essentially the altcoin market. You can see that from 2020, massive spike in the central bank balance sheet. We also saw a massive spike in others. And then as the balance sheet started to sell off, we saw altcoins sell off, and now we're kind of just in a malaise. We're in kind of a range. It's not a direct one-to-one correlation, but again, and this is something we're pretty familiar with as crypto people, more liquidity, higher asset prices. And so once the Fed stops this runoff, we can see liquidity even out and then, dare I say, even expand. Why don't you have a look at these charts? Because the Fed has been sneaky. They've been in QT, yes, but in the background, they've been doing kind of a hidden QE. Let me explain. So here you can see the Fed Treasury held under 1 year. So this is 1 year debt, 1 year or less. That's a Treasury bill. Any Treasury bond that matures in a year or less is called a bill. They've been selling off bills. What you can see in the 10-year Treasury debt that matures over the course of 10 years, they've been going higher. And so what you can see is that in 2009, QE1 was the first time they did QE. They added $43 billion on their balance sheet. What we've seen in 2025, they've added $58 billion already. So they've already been in kind of a QE situation. They've just been selling off more 1-year bonds, Treasury bills, than they have been buying 10-year bonds. And so the balance sheet's been going down, but they've still been doing kind of this QE in the background. That's because they're probably trying to keep a cap on 10-year yields. Because when you buy bonds, the price of the bond goes higher, the yield on that goes down, so the interest goes down. So if you pile in, you buy bonds, buying pressure drives up the price of the bond, the interest rate on that falls. And that's what you want when you're a government that's refinancing debt. You don't want to pay too much interest. You want to keep that down. That's a yield curve control. And so that's what the Fed is, I think, likely doing here, or even what they're very likely to do in the future. I think any kind of money printing is going to take the form of yield curve control, where quantitative easing is basically just, we're going to print money en masse and buy as many bonds as we can. Yield curve control is we're going to print money and buy bonds when we have to keep yields capped at a certain level. So that's what I think is going on here. It would be speculation because I don't think they've come out and really told us what they've been doing. And so what you can see here now is the Federal Reserve balance sheet change here in blue. You can see massive spikes over the years. The Fed funds rate. So when you start to see the Fed funds rate come down, what do you typically see? You see the balance sheet go higher. 2000, 2008, 2009. Interest rates came down, balance sheet went higher. 2019, 2020, balance sheet, Fed funds rate went down, balance sheet went higher. And so now we're here and we're starting to come down. It's going to be a long way before we get down. We're not going to get even anywhere around here until 2026. But as this comes down, I think this balance sheet's going to go higher. And so whether or not the Fed starts QE right away, I don't think they're going to. I just want to be real with you. I know a lot of people will take this news and run with it. Quantitative tightening is over. Oh, here comes QE. Here comes the money printers. They're distracting you. This is a distraction. They're just trying to get your clicks, your likes, your shares, whatever it is. Don't believe these people. The likelihood of the Fed running quantitative easing is not very high. Powell even came out and said it himself last February that they're not going to be doing quantitative easing until rates are at 0. And that's exactly what Booth goes on to say in this interview. Have a listen.
I think it's a little bit premature to be having this discussion about shifting gears from quantitative tightening to quantitative easing, because we're still debating whether or not there's going to be a subsequent rate cut at the December the 10th Federal Open Market Committee meeting.
And so what she's saying is that it is early to be talking about quantitative easing because we're not even sure if they're going to cut rates in December. And again, rates need to come all the way down to 0 for that to even be a discussion. Now, are there other ways for the Fed to get money into the system? Yes, there are. So not all hope is lost. Have a look here, US Fed and Treasury all stimulus. This was the 2021 bull run. This was Treasury QE, and this is what we've been in recently, where the Treasury sells bonds to private banks. That's how they get the liquidity in. Then you've got outright QE. That's the Fed printing money to buy bonds. Then you've got not QE. I'm not even sure what that is. They're sneaky sometimes. They'll find ways to do it, and they just won't tell us. So there's ways to get it done. And what we're projected to see into 2026 is Treasury QE. And that's what we've been seeing. We've seen the Treasury issuing bonds. Private banks are buying those bonds using credit. However, they can't do this forever. At the end of the day, there's only one balance sheet large enough and flexible enough to handle the sheer volume of the US debt, and that is the Fed's balance sheet. And so let's get to the burning question. When is the Fed likely to end quantitative tightening? When are they likely to end balance sheet runoff? When can we expect more liquidity to hang around. So I've got former Federal Reserve Chair Richard Clarida. He's going to give us his thoughts on when the Fed could end QT. I like what he has to say.
And so I think most folks, including us, have been expecting the Fed to stop QT probably in the first quarter of next year. So based upon what the chair said, and also based upon a pretty noteworthy decline in reserve balances in the last month or so, we could maybe see the QT coming to an end at the end of this year. So sometime in the next 3 to 6 months looks to be what the Fed is expecting to do.
And so his thoughts, similar to mine, that people were expecting QT to end sometime in the first quarter of next year, but due to the fundamental shortage of liquidity we're seeing in the financial plumbing, the Fed would likely have to end QT a little bit sooner. Again, that's not starting quantitative easing. I hate to be the bearer of bad news, but I just want to be real with you. This isn't going to be one of those channels where we just spoon feed you hopium. I'm going to keep it real with you because that's how you make informed, educated decisions. And so while, yes, we can look forward to less liquidity leaving the system, and that's a really good start. There's only one thing better than ending QT, and that's starting QE. But that's still pretty good. That's high up there. That's still number 2. So that's good. But we need to be patient. And that's exactly what this channel is going to help you do. We're going to help you remain patient, calm, and convicted in the turbulence that is the crypto market. And so if you appreciate this update and you want to get more updates like these on a regular basis, keeping you up to date with the world of macro, central banks, and all things related, you got to like and subscribe down below. Leave me a comment. Let me know if you've learned anything. Our goal here is to educate. Thank you for being here, and we will see you in the next video.